Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. There's another volatile week in rate markets, as this time another Anglo-central bank turned out to be more hawkish than expected, this time the Bank of Canada. I actually flagged the Bank of Canada once back in the summer when they were arguably the earliest central bank to step in the hawkish direction. The story's now come full circle. They put an exclamation point on the recent trend of central banks warning about future rate hikes. Specifically, they did two things. First, they guided that the first rate hike is possible by mid-year, which is pulling forward their forward rate guidance. But second, they ended their QE program. Now, they were already in the process of reducing that QE program over time. They had gotten it down to $2 billion a week. We thought they would take another incremental step of doing $1 billion a week and then end it at a future meeting, but they reduced it altogether. Now, recall our discussion around the Fed when we were talking about the taper, and our segment on how the Fed announcing the taper would end in the middle of next year was actually more important than necessarily when they began. Because when you end your QE or end, in the Fed's case, tapering, it starts the clock on when a potential rate hike might come, no matter what you might guide otherwise. So the same thing happened here in Canada. They ended QE. The market said, okay, that's nice, the mid-year commentary, and now price the rate hike in for the first quarter of next year for Canada. Okay, granted, Canada's the 9th largest economy in the world, so not the biggest, but certainly not the smallest. So why are we focusing on it so much this week? Well, the meeting caused Canadian two-year yields to rise by 20 basis points, 0.2%, while their 30-year yields fell 9 basis points, turning to a massive flattening of their bond curve. And that's pressured other bond curves in the US, UK, and Europe to do the same, that have already been undergoing a similar curve flattening and similar moves in rate markets due to their own central bank messaging. So again, why Canada? Well, birds of a feather flock together, as they say, and we should take heed. This is not a singular shift by one bank or two. It's not necessarily coordinated. I'm not saying that, but it's a lot easier when several central banks are moving at once or to be on the move together rather than one going it alone, because then that means you might have potential currency appreciation, and your financial markets might react in a different way than others. And if other central banks are all moving at the same time, it actually becomes a little bit easier. You get a little more cover. So that's why I take note that, especially as we head into next week, it's not just the Fed and the Bank of England, but you also have the RBA in Australia. So there's lots of opportunities to further inject volatility into markets from these Anglo central banks all starting to move together. Okay, so that took a lot of time, but it's important to also note that the ECB, once regarded as the more hawkish mainstay in the global central bank community, is not one of those birds. Here to talk about what Lagarde said this past week is Imogen, Bachra, our European rate strategist. So Imogen, central banks all over the world seem worried about inflation, but not necessarily the ECB. Tell us how Lagarde framed the inflation outlook at this week's meeting.
Yeah, I don't know if it's not that they're not concerned, because she definitely said, in the short term, there's clear concerns about the upward pressure on prices. She said, inflation was really all they discussed today, but they're very confident in their analysis that these are temporary factors, albeit perhaps less temporary than they first thought, and supply shortages are going to take longer to work through than they first thought. But they are still confident that, inflation will be high over the next few months. But in 2022, we're expecting to see a fall in those prices. And that's kind of how they justified their still accommodative stance.
Okay, so markets have reacted. To be fair to Imogen, we're recording this about only an hour after the press conference. So tell us about the market reaction and what you think we should expect going forward.
Okay, so I guess like all other, fixed income markets, Europe has priced in or repriced ECB expectations quite significantly over the last few weeks. So we pretty much had 2 10 basis point hikes priced in for the end of 2022. which, if you look at that side by side with the ECB's forward guidance, seems pretty inconsistent. So we were expecting Lagarde, as I think was pretty much consensus view, to push back quite heavily on that market pricing. She did push back against it, and she did say that it was inconsistent with their forward guidance, but I don't think she was explicit or as kind of clear around that as she could have been, and certainly not as forceful as I think most market participants were expecting her to be. So it wasn't a hawkish meeting, but Giovanni Zania, chief European economist, has termed it clumsily dovish. So the market reaction has been to now price in a couple more basis points of hikes by the end of 2022. We've seen 2s, 5 deepen, 10s, 30s flatten, and spreads widen. So really just a continuation of the market themes that were already happening today, coming off a big market moves after the budget yesterday.
Yeah, so still some flattening out there in European rates despite this. So,
yeah.
Do you think that, is there a possibility that Lagarde's seeing what's happening globally and just wants to keep some optionality in case she's wrong on the inflation outlook? Or do you think that more pushback on what's priced is going to be coming?
I wouldn't, to be honest, be that surprised to see something akin to an ECB sources article perhaps come out this afternoon or sometime later this week that might push back more explicitly against market pricing. She did say it, a hike by the end of 2022 isn't what they see in their inflation forecast, but she just wasn't as forceful and explicit enough as I think the market was expecting. So I would not be surprised to see some kind of clarification around that communication and markets to kind of stabilize slightly lower from where they are now.
Yeah, well, it's interesting and a little bit strange for having been in the markets as long as I have to now see the ECB being the most dovish amongst almost all of the major global central banks. So, all right, thanks, Imogen. That's all for this week, although it was admittedly quite a lot. Next week, like I said, we have the RBA, Fed, and Bank of England. So I don't expect volatility in rates to necessarily let up. Good luck out there, and we'll talk again next week. Thank you, everyone. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.